For the last century, commerce was a physical game. Success meant getting a product onto a shelf and hoping a human being would choose it out of the sea of sameness that defined the modern supermarket. The rules of business remained static because the target was a known constant, a biological human with a physical wallet, making choices based on what they see and touch. Because the buyer was a biological entity, the singular path to building a billion-dollar empire was mastering human psychology. If you could influence the internal triggers that made a person reach for your brand over a competitor, you won. But that historical baseline is currently fracturing. The definition of the consumer is splitting, making room for a buyer that doesn't navigate stores or respond to traditional persuasion. This is the rise of the agentic economy, where the next major purchasing demographic consists of autonomous code executing transactions without human intervention. The core tension of this shift is that you cannot market to a programmatic algorithm using human psychology. Code has no childhood memories to tap into and feels no emotional connection to a brand's story. This creates two diverging paths for modern founders. You can continue to build for the human heart, or you can begin engineering for the specific, cold requirements of machine code. To see how the human path is being mastered today, look at the $2 billion rise of the soda brand Poppi. When they launched, they focused on logic, positioning themselves as a niche gut health drink made from apple cider vinegar. They struggled because, for humans, health logic is often a barrier to adoption. This data shows that human consumers generally reject radical innovation in their daily habits. Massive adoption only happens when a product is roughly 10 to 15% better than a deeply nostalgic norm. Poppi pivoted to fit this exact curve. They abandoned the clinical health talk and rebranded to look, taste, and feel like classic soda. They leaned into the glow of nostalgia, just with fewer calories. They moved the buying decision away from the logical head and into the emotional heart, using vibrant neon packaging and a digital-first marketing strategy designed for TikTok-native aesthetics. This strategy eventually detached the product from health metrics entirely, focusing instead on pure celebrity partnerships and a cultural vibe that resonated with the modern human consumer. For biological buyers, survival isn't about logic, it's about brand. You win when you create an emotional resonance that breaks through the noise of the shelf. But at the other end of the economic spectrum, a different playbook is emerging for the buyers that don't have hearts. An AI agent is immune to aesthetics. It doesn't care about neon colors, and it will never be influenced by a celebrity endorsement. The only resource an AI agent needs to survive and do work is raw computational power, measured in flops and processed on physical silicon. This creates a transactional problem. While traditional banking APIs can facilitate payments, they rely on human-managed accounts and banking settlement times that are too slow for an agent processing millions of tasks per second. This flowchart shows the solution being built by infrastructure like the flop network. An AI agent routes a digital token directly to a decentralized GPU network, creating a spot market for compute that operates at the speed of code. In this environment, a programmable digital currency is optimally suited for the machine economy. It allows for near-instant settlement without a human gatekeeper, which is how the agent triggers the allocation of its own survival resources. When selling to an autonomous machine, emotional marketing is useless. The ultimate metric of survival is engineering for zero latency and frictionless utility. These two extremes, the emotive soda brand and the efficient compute token, represent a new economic reality. The middle of the market is disappearing. In a macro environment where capital is abundant due to aggressive money printing, but human attention and machine compute are scarce, the market separates. Investors and consumers alike stop rewarding adequate products that try to sell through moderate logic. Massive value is now accruing strictly at the two ends of the barbell: companies that capture pure human emotion or infrastructure that provides pure digital efficiency. Founders must choose their consumer, biological or algorithmic, and play that specific game to its furthest limit. Building for the middle ground no longer leads to the shelf, it leads to failure.